For decades, the best advice for retirement investing has been incredibly simple and consistent. But a massive shift is happening right under our noses. So today, we're going to break down why the rise of AI is forcing a major rethink of a strategy that's worked for a whole generation. And yeah, that's the quote that really caught my eye. It's a huge change of heart from a long-held belief. I mean, what could possibly be big enough to shake up one of the most trusted rules in personal finance? Let's get into it. Okay, so first we've got to understand the old rule that's being challenged here. For years, the go-to advice was to put your money into something called a low-cost U.S. equity index fund. Sounds kind of complex, right? But really, it's beautifully simple. This whole strategy really just boils down to three simple ideas. An index fund just means you're not trying to pick the next hot stock, you're buying a tiny piece of the entire market. And low cost? This is huge, because even tiny fees can just gobble up tens of thousands of dollars over your lifetime. And U.S. equity means you own a small slice of the whole American economy, from tech giants all the way down to your local drugstore. So how does this actually work? Well, it all comes down to something called market capitalization. The fund doesn't give you an equal slice of every company. Basically, if a company like Google is, say, 30 times more valuable than a company like CVS, you end up owning 30 times more Google stock. It's automatic. Your investment just mirrors the economy. It's a system designed to be totally passive and, diversified. Or at least it used to be. And that right there, that brings us to the real heart of the problem. See, that super reliable, diversified investment, it started to look, well, really different over the last few years. I mean, just take a look at this. If you put your money in a classic S&P 500 fund today, that's the 500 biggest US companies, you're not getting this nice, even spread you might think you are. Not even close. In fact, just 10 companies make up a whopping 38% of your entire investment. And the other 490 companies, they're all just crammed into that other 62%. So let that sink in. 38%. That's the key number here. I mean, for something whose entire sales pitch is diversification, having almost 40% of your cash tied up in just 10 stocks, that is a historic level of concentration. That safety net you thought you had, it just got a whole lot smaller. But wait, it gets even crazier. This isn't just about big companies in general. It's a huge pylon into one very specific, and let's be honest, very speculative sector. So you start looking at the names in that top 10, and a pattern just jumps right out at you. These are all the heavy hitters of the tech world, right? Names we all know. So what's the one thing that connects all these massive companies right now? It's not just that they're big tech, it's that every single one of them is betting the farm. We're talking trillions of dollars in value on one thing: artificial intelligence. And that right there is the big problem. So without even realizing it, if you just own a simple S&P 500 fund, you're not just passively riding the market anymore. No way. You are making a huge speculative bet that this handful of AI giants is going to take over the world. And that is a way riskier bet than just betting on the whole US economy. Okay, so you're faced with this new reality. What do you do? Well, the idea isn't to just throw the old strategy out the window. It's about tweaking it to handle this new risk. And the proposed change is actually pretty straightforward. The thinking is you keep about 75% in that main S&P 500 fund, but you take the other 25% and you deliberately use it to spread your risk back out again, to rediversify. And that 25% gets split up. You put it into a few different things to balance out that big tech concentration. You've got a value fund in there that focuses on more stable, maybe less flashy companies. You've got midcap and small cap funds for smaller American companies. And you have an international fund to get some money outside the US altogether. The whole point is to intentionally bring back that wide diversification that's kind of disappeared. Okay, so inside that new strategy, there's one idea that's really interesting and kind of forward-thinking. It's this focus on smaller companies. So here's this really fascinating theory about where things are headed. On one side, you've got the giant AI providers, Google, Microsoft, NVIDIA, right? They're burning through billions, their stock prices are through the roof, and they're going to be fighting each other on price. But then on the other side, you've got thousands of smaller companies. They're not going to make the AI, they're just going to use it. They'll use it as a tool to get more efficient, make new stuff, and actually capture the value. And this all leads to a really contrarian idea. What if the real money, the real winners of this whole AI revolution, What if it's not the handful of giants building the AI, but the thousands of smaller companies that actually use it? Think about it. What if AI just becomes a cheap tool that anyone can use? Then the real value flows to the user, not the provider. Now, of course, this new strategy isn't a silver bullet. It's got its own risks. It's a calculated gamble, not a sure thing. And that really brings us to the main point of all this.
And this is why it's not such an easy decision. Just look at this. If you look at the last 10 years, betting on small companies, that's the Russell 2000 index here, would have made you about half as much money as just sticking with the S&P 500. The old strategy has worked incredibly well. So making this change isn't about chasing what did well. It's about trying to protect yourself from what might go wrong in the future. And that, right there, is the key takeaway. These golden rules of investing, they aren't written in stone. They're not timeless. They're just strategies that work well in certain conditions. And what this all suggests is that the market itself might be changing in a really fundamental way. What used to be diversified is now concentrated. What used to be safe might now be a gamble. So this all leaves us with a pretty big question. This isn't just about stocks and funds, It's a much bigger challenge we're all going to face. When a technology like AI comes along and promises to change everything, just sticking to the old rules might not actually be the safest move. The real trick is figuring out when and how to change with the times.